Access to Chris Pulver's trades with A1 Trading's Pulver Alerts. Watch as Chris Pulver, a seasoned trading pro, navigates the markets, manages risk, and applies a disciplined trading process. Join today to level up your skills and learn from Chris's wealth of experience. Get Pulver Alerts now.
Good morning, everybody. Happy Thursday. Screen share is coming up right meow. How's everybody doing today? So, interesting day. We had some more inflation readings, and guess what? Inflation's higher. Guess what? The market's kind of reacting to the reality of like, oh, wait a minute. I would say there's some heavy amounts of manipulation going on yesterday to today, right? Market got real excited about that move with no real data to support it. We just ripped higher using CPI as potentially the catalyst, and the market's headline says benign, which it really wasn't. It was higher. Anyway, markets go up higher yesterday. Nasdaq make all-time highs. That was the headline as we crossed 20,000 for the first time. We've crossed 20,000 by a pretty big amount. SPY just shy of the all-time highs. And what are we doing today? PPI comes out. We're fading that move. We're right in between, right? We have a gap from yesterday's close to today's open. We have a gap from CPI yesterday that the market is kind of tapping into. I'm not sure if the market is going to be filling this gap, but I asked this question earlier in my session. Would this surprise anybody to see this type of price manipulation, to see CPI push everything up, PPI, or just market reality pushing things down? And all it is just a lot of price manipulation. But overall price doesn't actually go anywhere. Okay, you heard me. Right meow. Okay, so anyway, where are we for the week? Well, we're still red on the week because we started off back-footed on Monday, and we're right back where we started for Monday's trading. Now, obviously, there's a lot of chop to go from lows all the way up to the highs, back to the lows, or if we go from lows to the highs and we settle somewhere in here for the rest of the week, that's price being price. We come into next week with the Fed. Is the Fed going to be able to drive price higher? Are they driving it lower? Are they driving price anywhere? It's the last full week of trading, right? So if we look at our calendar here, this week's trading to next week's trading, this is it. This is the last week of trading with the Fed. Fed on the 18th. Okay. It's now like a 98% chance they're going to cut rates. I'm just going to show the data here. I think this is interesting. Okay. So if we go into the watch tool, 98.1% chance the Fed is going to be cutting rates next week. That brings us down a full 100 basis points since September. We go to inflation. Let's take a look at our previous and last print in some of our currencies. So Australia, Canadian, Swiss, Euro, Pound, New Zealand, dollar. So let's start in alphabetical order. Australia, previous print 3.8. Australia is the last print was 2.8. So Australia, I'll type this out. I did this for my session earlier. Australia, I'll just type in the currency pair so I can do it in alphabetical order. So CAD, Swiss, Euro, Pound, New Zealand, and dollar. All right. So which way is their country headed as far as inflation goes? According to this, Australia 3.8 printed 2.8. So Australia inflation is trending lower. Okay. Canada 1.6. Last print was 2, higher. And the BOC just cut by 50 basis points, didn't they? The Swiss, we got to go all the way down to S's for Switzerland. Switzerland, 0.6 came in 0.7, 1/10 of 1%, but still higher. How about the Eurozone? Okay, you can go to all these different countries. Germany, 2 to 2.2, that's higher. Go to the European, I was going to say Euro area, Euro Union, 2 to 2.3, 2.1 to 2.3, higher. So inflation is going higher. The Eurozone just cut by 25 basis points today. The Swiss also cut 50 basis points today, which was a nice surprise. Currency strength. Nice little reaction right out of the news this morning. Swiss is our weakest currency pair, which I'm obviously happy to see. Got a nice little P&L swing in my currency pairs. Let's go back to inflation. Where are we at? UK. UK 1.7 printed 2.3 last. That is trending higher. How about Japan? Japan 2.5 printed 2.3. Japan's actually trending lower. New Zealand 3.3 printed 2.2. That's the last print, so they're trending lower. And dollar, we just saw it today. CPI yesterday, PPI today. US is trending higher, 2.6, 2.7. Okay, so CAD higher, Swiss higher, Euro higher, Pound higher, dollar higher, higher inflation, cutting rates. Aussie lower, New Zealand lower. Aussie's pausing. New Zealand's already cut rates. We're at 4.1 for the New Zealand right now. What's their cash rate at? 4.1 or 4.2? It's a slight positive swap on Aussie New Zealand. If you're long Aussie New Zealand, it's actually favoring the Aussie right now at 4.35. Japanese yen down, New Zealand down, Aussie down, the only currencies. So we have 1, 2, 3, 4, 5 of our major currencies with higher inflation readings. And these central banks are all cutting rates. Interesting. We go into, I said that the data point, one data point doesn't make a trend, but with inflation readings right here, 2.7 came in 2.7, 2.6 came in 2.6, 2.3 came in 2.4, but that was our bottom. So we are no better off. If I just draw a straight line, we are no better off than where we were summer of last year. There you go. So we're right back where we started. Is it slightly lower? Sure. But give it another month or two. If we go another 1/10 higher and we're printing right here, and a 1/10 higher, we're printing here, right? If that's our trend, it's clearly going the wrong direction. Okay. What we don't have by the end of the month, and I actually looked at this morning, we don't have a PCE print in the US. So I wanted to look into that and see what the print was in November. So here's our CPI data. How about the news for this morning's PPI? I looked at the history here. Let's go back to overview. Let's go back to the economic calendar. There we go. So here's our news from this morning at 8:30. Here's all U.S. news at 8:30. So jobless claims up a little bit. Core PPI forecasted 0.2, came in 0.2. Okay, the previous was 0.3, but this is where I think it gets to show us that there was a bit of a miss. Okay, higher inflation. 3.2 is forecasted for core PPI year over year, came in 3.4, 0.2 higher, and also the revision was higher. We had a revision from 3.1 up to 3.4. That is higher PPI. We had initial jobless claims also higher with a revision that was slightly down by 1,000 higher on the revision, but missed by 21,000 on the initial jobless claims. We have month over month and year over year for the regular PPI, not the core, but also 0.2 came in 0.4, 2.6 came in 3.0, and the revisions also higher, 2.4 up to 2.6, 0.2 to 0.3. So just this alone, and I know that this is technically not the preferred measure of inflation, we've been told that it's CPI and core PCE that the Fed pays attention to. Okay, so we've got CPI that came in as expected, but it's higher than where we printed during September's data in October's print. Okay, so we have October, November, and December all printing higher CPI. We have October, November, and December all printing higher PPI. How about PCE? Take a look. PCE. This is US core PCE year over year. As I said, one data point doesn't make a trend, but if I zoom in here, can you see how this looks very similar to the Edge Finder when it comes to the low in September, and we are trending higher? So take a look here. Here's June, July, August, September, October, November, and we're not going to get a print for December. Unfortunately, we're gonna have to wait until January. If somebody can find it on the calendar and show me it's here in December, let me know. But usually they sneak in the PCE at the very end of the month. The market's already kind of digested CPI and PPI, and PCE just kind of comes in, but it does matter. Okay, so we are trending higher. I mean, really, this is kind of interesting. We flatlined in summer of this year with basically the same print. I also find that hard to believe that we've had perfectly aligned, like, oh yeah, PCE is just totally fine at 2.6%. Well, it's 2.8. And on top of that, the reason the Fed has been restrictive is because our official cash rate was well above the core PCE. Well, now it's getting less, right? Like that gap is narrowing. We're going to be down to 4.25% next week. So if we decrease down to 4.25 on the Fed rate, and we look at the core PCE at 2.8, let's say we print 2.9 or 3%. Now we have the Fed sitting there like maybe 1 to 1.5% buffer, as opposed to like a 3% buffer. That's a big difference. So will these paths cross again where core PCE and the Fed rate all of a sudden are aligned? Is that the Fed saying like, well, that's good. Now we're neutral. Now we're no longer restrictive. But that trend, I mean, if you give inflation momentum, I feel like it's going to get hotter. If consumers are stupid enough to keep paying for stuff that's more expensive, you've got way too much money chasing too little goods. That's inflationary, right? We go into 2025 with potential tariffs. That's inflationary. You've got money supply going to everything. That's inflationary, right? You've got China trying to lift animal spirits. That's inflationary. You've got positive sentiment and the assets going and ripping higher in the U.S. That's inflationary. Yes, the best way to fight inflation is to be a trader, to be an investor, to be in these markets, to have assets, to be an owner. So you can offset this. It's not what I'm saying that I want to be bearish all of a sudden, but I'm saying this market is likely going to face another reality check. Okay. So the data is not supporting that everything's looking good. This whole like soft landing scenario, I think we were told that it was coming. The Fed, I'd say, threaded the needle pretty darn well. The market didn't overreact in September, although it could have, right? It didn't. Like August was the Volmageddon event, and September was, fighting the good fight and get right back to all-time highs. And we had a great September, October. The election, lifted the market to new heights, and it's just going to be interesting to see how the rest of the year unfolds. So where are we? We're sitting here near all-time highs. I keep talking about this cushion where I want to deploy cash at better prices. If the market melts up higher, so be it. If somehow we fill today's gap, I mean, and look, I'm not a hater here. I mean, we started off on a rough note this week. We had Monday, Tuesday sliding. The market ripped up on CPI. If this is enough to just keep the market saying, hey, look, it's okay that we had a low on CPI. We ripped up here. We pulled back again. Let's see if this market does have what it takes to hit all-time highs. Can it do it by today or tomorrow? I don't know if the PPI news is going to be that much. But if we fill today's gap, okay, let's say that we fill today's gap. Let me use my drawing tool here. So let's say we fill today's gap, and this gap is still just offering support. Are we able to eke out higher highs? Maybe. Can we get to 6,100 on SPX? Can we get to 609 or 610 again in the SPY? We're right there. Right? We're right there. So you can see everything is in red right now. The Qs have been outperforming, but also you can see that added volatility. We're down 0.2% in the net or the S&P. We're down 0.4 in the Qs, but they've made a really nice rip to the upside. So S&P has not made a higher high since the 6th, which is last week, right? That was our last all-time high. That was number 57 for the SPY. Now, could we get there by the end of the year? Sure. We have the Fed next week. We then have disrupted trading with holidays. But if the market's going to drift when it's open and drift higher when it's open, we could still carve out another all-time high by the end of the year. It wouldn't surprise me. This market could care less about reality right now. Okay. And that doesn't mean that I'm short. Doesn't mean that I'm bearish. It just means I'm getting ready. Getting ready for some type of hiccup, some type of fumble. And maybe it's debt ceiling in January. Maybe it's tariff talk in January. I don't know. Maybe it's the Fed the 18th. If they want to really squash this end of year rally, then the Fed's going to say something to the effect of like, inflation is increasing. We're probably looking to be a little bit more neutral going into 2025. And the market all of a sudden thinks that they're not going to cut it all in 2025. But I don't think the Fed is going to be that definitive and that explicit. I think they should be thrilled with themselves, and they're going to have a holly jolly Christmas because they somehow navigated these markets to all-time highs with cuts and inflation that has had a wild ride the last couple of years. Okay. So anyway, we'll see what happens. As I've said this last, couple of weeks, I'm looking for some type of correction to deploy capital. If I don't get it and I just enjoy the melt up, that's fine. I'm going to continue to play some hedges at least to the end of the year. I'll continue to play hedges into Q1. Okay. About gold, yep, we'll talk about everything here. Any bank reports you recommend to read? What do you want to read on that, Devinder? I mean, right now the big story in FX is, central banks are cutting. Fundamentally, I'd say your cash rates. I mean, it's an interesting story in currencies right now. It's like the dollar index. Let's talk dollar index for a second. So dollar index is doing exactly what I thought it was going to do. We came back to that 4-hour 200 moving average, and we're ripping higher. Ripping might be a little bit aggressive, but we are going higher off of a pullback. So, the dollar from this bear trap squeeze that we called, rip up, pull back, headed higher for that follow through. We came right back into a nice little pocket. We started to bounce there. That actually coincided with it was like was that a PMI crash in the Eurozone? That was back in November, right? That was like a PMI kind of a crashy move where it brought the euro dollar down to like 103.30, and then it went all the way back up to 105.50. That was a big reversal. But here we are. We bottomed out right here. It was a really nice play on the 4-hour time frame, and this thing's up. Okay. Yeah, Swiss yen is working out great, isn't it? Swiss yen is good. Swiss yen is I'll say better. Better. I'm hoping that the rotation into the Swiss getting weaker. This is a really nice looking pattern, so I'm holding this one short. Okay, if this is a larger crown pattern, I've measured symmetry on this one down to 164. I'm going to take some profit on Swiss yen at 164. I'm still holding long in all my other Swiss pairs. So Aussie Swiss, I've leveled in a bunch of times on this one. CAD Swiss, I've leveled in a bunch of times on this one. Euro Swiss, Pound Swiss, New Zealand Swiss, Dollar Swiss. I'm still being very patient on these levels. I got these yellow boxes measuring my symmetry moves. I'm still going to hold these things. Okay, let's go back to the dollar index for a second. So I said this on the 4-hour time frame. It bounced right off the 200 EMA on the 4-hour. It's right here. Okay, so you can go back for the last couple weeks when this thing bottomed out. I said watch for this support at the 200. You got support. You got some direction. This has not been invalidated. So if you are long the dollar, that's a good play as long as this doesn't invalidate with the daily candle close below, and that price is 105.50. Okay, I don't know what day it was, but I said my line in the sand is 105.50. If we stay above it, I'm long. We stay below it, or we close below it, daily confirmation, I'd be looking to short the dollar. It's long. So through the rest of the year, again, with the Fed next week, I wouldn't be surprised if the dollar continues to trend up here. And then we have a range that we have to make a decision on. Is this going to be a topping point where the dollar is range bound? Maybe. Okay. Is this dollar going to continue to run hotter going into early 2025? Look left on this chart. This yellow box is also a larger pocket. This is a big inefficiency I have on the dollar index. I think the big surprise for the dollar would be this. If we came back to fill this pocket all the way up, okay, if we form a topping pattern, that would be an excellent way to short the dollar. I think the big surprise to me would be if this dollar came all the way back up here to these multi-year highs. That type of trend would, I think, do a lot of damage in the currency market to see the dollar get that much stronger. That would probably push the euro down below parity again. That might push the pound dollar back down to like 115, 120 or 115. That might threaten some big, not necessarily historical lows, but some big significant lows on like Aussie dollar, New Zealand dollar, if the dollar continues to run hot. Okay. But now that the Fed is going to be sitting at 4.25%, the carry trade is negligible on the dollar. If the dollar's sitting at 4.25 with another cut coming in Q1, if the RBA and RBNZ just hold right now, okay, then they're going to have equal swap to the dollar. Doesn't mean the dollar can't get stronger. Doesn't mean this carry trade is live and well, but it neutralizes some of the appeal of this carry trade. Okay, so I'm watching the dollar index for this area to be either a range trade right in here, where you saw that the dollar had some range potential, right? A lot of these tops that have happened on the dollar have been range tops. So I'm looking for that area to form another range top. And then if we start to break down, there's my trend. All right. So I'm watching for the same high here to be a bottom. If I'm wrong on that, I'm looking for a divergence. If we go higher here, I'm looking for a divergence and then see if we have a topping pattern. So maybe it's a head and shoulders, maybe it's a crown pattern, but if we have a topping pattern, I'm looking to short the dollar on a swing. Currency pairs that I'm in right now, I'm still long Aussie dollar, I'm still long New Zealand dollar, and I'm long dollar CAD, dollar Swiss. Okay, I'm not in the euro dollar. I closed out my pound dollar for a small loss yesterday. I lost like 38 or 40 pips on it. But the Aussie dollar, New Zealand dollar, dollar CAD, those are position trades for me. I'm scaling in and building my positions up. Dollar Swiss, I've built that position up over the last 2 years. I was in that since late 2022, started getting positive swap in 2023. I'm still in that trade. Okay. So There's still more to unfold on the dollar side. I'm watching price carefully. This is an easy way to kind of assess the index on where we go with the dollar. Japanese yen, still my least favorite currency pair in basket. The FOMC next week on Wednesday, piggybacked by the BOJ. Watch out for some, late year shenanigans by the BOJ. Maybe they come in swinging with, I don't know. Just be ready for anything silly. Trade short term on the Japanese yen. Follow probably nothing larger than like a 1 hour time frame if you're trading the yen. Otherwise, stay out of it. If I get a better picture, better outlook on the yen, I'll trade it. Otherwise, I don't know. I just talk a lot of crap about the yen because I hate it. It doesn't trade like a currency to me. It trades like a stock. It's like when it runs, it rips and it goes for thousands of pips and it drives me crazy. There's no structure, there's no pullbacks, there's no pivots, there's no efficiency, there's no equilibrium until later. I mean, a move that can go thousands of pips and then it pulls back, it goes, half of that or 38% of it. It's like it does make sense eventually, but those cycles last way longer than I think most traders in a leverage market, especially most traders don't survive those. If you're in the wrong side of the yen, you get your butt kicked. So I would just rather advise traders, and it's not financial advice, of course, but encourage traders to never fight the flow of Japanese yen because when it moves, that momentum is really, really strong. Okay. All right. Let's see here. If we see unemployment 4.4 next time, you think the dollar would still be strong? Look, let's just talk reality. Okay. Reality check for the U.S. economy. Okay. So we've had a fantastic bull market since 2022 Q4. We got out of the bear market in 2022 in Q4. We ripped hard in October's bottom into November. November was a great recovery into the year, and then 2023 picked up right where we left off. It was mostly led by Mag 7. Led by Mag 7, extended with a broader tech recovery, and then extended further with AI and semiconductors. That's where NVIDIA started to really pick it up. And then everything that was in semiconductor space, SMCI, which is now a dumpster fire, AMD, Micron, AVGO, Broadcom, like even legacy techs like your Intel started to make moves on this, and Oracle started to make moves on this. Dell started to make moves on this, right? I mean, 2024, outside of a little pullback in April, which was a reality check because the Fed was still stubborn on saying we're not going to cut rates, right? And April was a little pullback, 5-6% in the SPY and the Qs. August was the closest thing to a scare because we had that deleveraging in the Japanese yen. We saw that the weekend from a Friday to Monday was the biggest 2-day sell-off in the Nikkei ever, 17+% in a 2-day window, 27% peak to trough. That was a huge drop in the Nikkei, and it did affect the U.S. market in a big way. Okay, that was the closest thing we had to a I'll say Volmageddon event like we had back in 2018 January. But the market didn't care because the typical September effect didn't last. We had that scare in August and the market ripped all the way back up through August to recover. And then September's like, we're fine. We had a little hiccup right after Labor Day and the market ripped higher. We're at all-time highs again by September. So September was actually a positive month. October was another drift higher, and November was a crazy month. Okay, so reality check for the U.S. economy is we've had a bull market running hot since Q4 2022. Now, it doesn't mean we can't go higher, doesn't mean we can't go further. I would say this, the reality check would be the pace of this growth and these gains will likely slow. Okay, why is that? We can't have a broad market rally when 10 stocks are performing well and 490 are lackluster, right? This whole rotation in this narrow market breadth and this very highly concentrated bull market, that can't last. It's not sustainable, okay? And right now we're sitting here with S&P price to earnings is historically high. Is it the highest it's ever been? No, but we're getting up to that like 26 and a half, 27. The historical average is somewhere between like 17 and 19. So percentage-wise and percentile-wise, we're up to one of the higher levels we've seen in a long time. That's historically high. What typically gives us reversions is historically high valuations and price to earnings. If it's price to earnings, price to peak earnings, price to sales, price to peak sales, all these things are getting historically high. Okay. So what that means is the markets are priced for perfection. So that means Q1 earnings of 2025, which would be Q4 data, it might still carry on into Q1 of next year, right? If you think about how strong companies are in their position in 2024, if we have a good rest of the year, that Q4 data that prints in Q1 2025, we could still have a strong earnings showing. But after that, I feel like it's a reality check. Okay. So if we're lucky to extend this bull market, it's through this year and it's into Q1 of next year. I think that's about my window of like, okay, I could get my head around this thing going a little bit higher, a little bit longer, getting longer in the tooth, getting over its skis a little bit, but there's still room to run. Okay. So could we go into that with a strong Q4 into Q1 print? Yes, we could. But after that, will this hot growth continue? Okay. Borrowing costs are still high. Look at the US 10-year. If the US 10-year yield is higher, not good, right? If you look at where we were in September on the 10-year yield, it was down a lot and it's ripped up 80 basis points from September. That's not good. Everything is based on that, right? Mortgage rates, auto loans, student loans, borrowing costs, restructuring, corporate debt, all of it's based on that 10-year. If that thing is trending higher, that will choke out growth. Okay? So that's a reality check. If it goes lower, sure, maybe things get better and things get cheaper, maybe. Okay? We also have inflation. Okay? It's not going away. So for us to be told 2%, 2%, 2%, we're now trending in the wrong direction. We've got enough data now in 3 prints to show that our trending direction is not down. Okay. Is it going to be a huge second wave of inflation? Remains to be seen. But with added money supply and animal spirits getting lifted, greed and complacency in the market, and tariffs potentially in 2025, I don't know how inflation is going to all of a sudden go back to where it was, down. I don't know how we're going down again. You know, it's not going away. And so the only thing that pushed it down lower was having a very hawkish and restrictive Fed, and they are not that anymore. And I don't think the Fed wants to pivot and wants to raise rates in 2025. So if they do that, that's clearly them being reactionary and showing that there's a policy misstep somewhere. That's going to be bad for the market. But I doubt they'll do that. They'll probably just try to hang in there and hold rates and just stop cutting as much as they've been the last 3 months. Okay, but it's not going away. What else do we have here? You know, I would say just technicals. I mean, technicals, how many charts are above the 50 SMA and above the 200 SMA? It's like 65% right now. Okay. Now that's not historically like, oh, that's a bear sign. No, it's not at all. Okay. But it's how far above are they? Okay. If we see 300 plus bar counts, and this is all technical stuff here, if we see 300 plus bar counts from price and the 200 EMA, I use an EMA for a lot of my moving averages, the 200 EMA, and we see a big stretch away, let's say 10 to 20% higher than 200 EMA, that has pause or reversion written all over it. Okay. That is the reason I said this week that I think NVIDIA will not make all-time highs, but it will rather hit the 200 EMA first. That's what I think. We're at 470 plus bars. We had a 45% stretch away move. Now we're up into the 20s. I think just that reality is it's going to find a way to stall and oscillate and let those moving averages catch up, or we actually have a bearish move. There looks like a pretty good head and shoulders or topping pattern on NVIDIA, on SMH. Pretty much on every semiconductor stock, it looks like there's a pretty big topping pattern. Okay. All right. So all these things. Now, does all this mean crash? Okay. In my opinion, no. I think no to a crash, but I would be fully prepared. Okay. Mentally and financially, I would be prepared as a trader, as an investor to withstand a 5 to 10% pullback, like minimum. Okay. Like if we talk about crash, then we're going to exceed 10%. We're going to have like a flush down and then another flush down. And we might be talking 15 to 20% pullbacks. But if I ask everybody in here, if you have a 20% pullback being offered by the S&P, would you rather be a seller or a buyer? Everybody smart that thinks about the last 90 years of trading should be thinking, if I have a 20% discount in the S&P, I'm going to buy it. And I don't care if it goes from 20% to 30%. I'm still going to establish positions at 20%. If it goes down to 30%, I'll establish more positions. If you want to be generating a huge gain over the next 3 to 5 years, then you would buy a 20, 25, 30, 35, 40, 45, 50. You would buy in at all those levels if you have the cash to do it. You will make a fortune when eventually the markets get to all-time highs. It may take a year, it may take a couple of years, but a 30, 40, 50% pullback is a massive upside gain. But you have to have the cash to do it. And this is why I said this week, my biggest warning out there is for everyone that is fully invested and not prepared for any type of downside, you know? So just saying, I don't think it's going to be a crash, but I would be fully prepared for a 5 to 10% trim. Okay. And it's just going to be a reality check. And I don't know what the catalyst is. I don't know if it's all these things I mentioned. I don't know if everything that happens in 2025 that gives us this potential reality check, it's not even on here. It's something I've never even talked about. It's not even crossed my mind. I'm hoping that's not the case. I'm hoping I'm thinking enough outside the box that there's something on my radar that actually makes some sense to see why the market would correct. But if I'm wrong, it's something else. That's why they're called outliers, because nobody's talking about it, right? But I would be prepared for that 5 to 10% trim. All that is to me is technically pulling back to all my cushioned EMAs on my charts. My daily time frame is so overstretched. It just opens up all those levels. So when I go back and show you the charts here in a second, that's what I'm looking at. The SPY pulls back, the Qs pull back, the Russell pulls back, the Dow pulls back. Any stock, I mean, Palantir, Carvana, Progressive Insurance, Geico, you know, Amazon, Meta, Netflix, Apple even. I mean, all these stocks look the exact same. So can they melt up higher? Sure, they can melt up higher. But man, I think that I look, I would like to be I'd like to be buying lower. I'd like to be establishing positions lower. And the tricky part too is if you establish positions, just remember they can get worse, you know? And like thinking about the S&P, if it pulls back 10%, we establish positions. The S&P, okay, the S&P could be I don't know, going to a 10% pullback, then all of a sudden we get to all-time highs, but Apple could pull back, 15%. Nvidia could pull back 20 to 25%. Netflix could pull back 20%. Meta, we've seen Meta crash, 40, 50, 60%. So just be careful on how you choose your levels. If I'm going to be smarter and kind of, withstand the drawdown, I'd much rather trade the indexes. They can absorb the haystack. There's a lot less volatility when if one individual stock gets crushed, the S&P is going to have that just kind of weighted in, but it's going to be a fraction of that type of fall, you know? So, I mean, if the entire Mag 7 drops, it's going to drag the S&P down hard. It's going to drag the Qs down hard as well. But if you want a little bit less volatility, I think, trading the index is a little bit easier to establish those positions. Okay. All right. So do I think there's a crash? No, I don't think that we're having like a bear market crash. I think it's exhausting to see like the bear porn and the doom and gloom and like you've got this and prepare for the end of the world. It's not that, okay? But I think that the market's going to struggle to rip 20 to 25% higher, 30% higher. We've had a heck of a run in 2023 and even into 2024. This would be 2+ years at 20+% gains. That's only happened 3 other times in history. Okay. So we are in some very rare air when it comes to how bullish this market has been since the end of 2022. When we finally established that bottom in 2022, this market has been ripping higher. Okay. I know I've said rip a lot today, but it truly is like we're talking extended moves, overbought conditions with lots of percentage distances between, current price and these moving averages. And I'm just just trying to be patient. So, and truthfully, it's a little exhausting to know that there's better opportunities ahead to like get things at discounts, but to see that it's just not coming. It's not coming yet. It's not coming yet. It's not coming yet. And so I'm just sitting and collecting a little, 4.5% position on cash, which is fine. It's unallocated cash. I get a little, I play GOVT and BIL in my portfolio, so that gives me some cash yields. But as soon as I need it, I close out those positions and I allocate the cash, and I've got 40+% of my portfolio in cash right now. Now, if we melt up for the rest of the year and we have a 58th, 59th, or 60th all-time high, we hit another chunk of highs in the Qs, there's more money to be made. There's, maybe another 2 to 5% to the upside for me. And I'll take that upside on a melt up for the 0.25% that I'm hedging. And going into Q1 next year, you're going to see this on repeat. I'm going to hedge pretty much every month. Why? Because if any of this starts to happen, whether it's Q1 or Q2, okay, and there's also typically a honeymoon phase when it comes to a new administration. And I know Trump has been president before, but if he comes back in for a 2025 into 2028 window, usually that president gets like a 3 to 6 month grace period where things just kind of stay the course. And so that's what I'm saying. Q4 data could print very, very well and at least hit expectations in earnings. And if the Fed is going to be somewhat accommodative where they're not looking to pivot and raise rates, but they're still pausing with this 100 bips lower, the market's liking that so far. That's why we've gotten to these all-time highs through the rest of this year. So there's a lot of things that are still fueling, but it just feels like, the gas light is on. We're on the reserve tank right now, and we're just drifting. And I don't know how much farther we can go, but we'll find out. I'm just saying, be prepared for at least a trim. And why do I want to trim because I want to allocate some cash. I want to deploy some capital at better levels. And there's a lot of opportunities to buy an index. There's a lot of opportunities to pick up some good discounts on stocks. Nick and I talked about this in our session we did back in November. I think it's quality over quantity in 2025. I think quality is, even if we have a choppy, not really a crazy bull market, but it's not a bear market. It's just kind of it's just a weird environment where it's like the market maybe gets a little splash reality. It's not gangbuster growth like we saw the last couple of years. And there's a lot going on, right? We've got a lot of potential policy shifts. It's just like, I just think that everything has to go right to maintain the pace that we're on right now. And that's hard to do, And here's the other thing. What happens if the U.S. economy starts to slow? What happens if unemployment starts to trickle higher? What happens if inflation data starts to trickle higher, right? People are already exhausted with inflation. They're exhausted with the economy, feeling like they're no better off. The only people that are somewhat happy would be investors, because 401ks, retirement plans, financial advisors seem like they're the smartest people in the world right now because they're just invested in the markets at all-time highs, right? But everyone's on the hook for the risk. A financial advisor is not hedging your portfolio. I'm sorry. The best thing a financial advisor can do would be sitting in some type of cash that's getting yield and be ready to reallocate and deploy if the market is going to go down. But they're not. What they do is they keep you pretty much fully invested all the time. And you are highly, highly correlated to what the market does. If the S&P gives a trim for 10%, your 401k is going down 10% or more. Because if you're aggressively in, Mag 7 stocks and they have a hiccup, or you're aggressively in Nvidia, or you're trading yourself and you're aggressively in all this stuff that has like high growth, or you're in a bunch of freaking double leverage instruments, you're going to feel it, So I guess I'm using today's session and this whole week, for example, as like a public service announcement. I just don't want anybody to be caught off guard, right? So I don't know what the outlier is. I don't know what the potential catalyst is. But I do know that if it happens, we've talked about it. So I will be on the sidelines with 40+% of my portfolio in cash, just waiting for more opportunity. Now, I still enjoy the melt up. I can still have leverage gains. This is why I trade options as well. Positions still close out. I can still speculate. I can still trade income trades. It's fine, right? But I don't feel the need to be really aggressive at these levels. I think this is the worst possible time to be sitting here going all in. All in was, I would say, after the August Volmageddon event, it was a hard one to say I'm all in, but having some cash to deploy certainly helped. And I was pretty aggressive going into the election. I got paid in that election in a big way. I mean, I had a huge month. My November was up almost 9%. That's a big month for me. Okay. But now we're in drift. We're in orbit. It's what's left in the reserve tank. And I just don't want to be caught off guard and having a big drawdown if the market does, face a reality check. And there's all these things stacking up. And what makes for a reality check? The fastest reality check is a mad consumer that doesn't want to buy anything anymore, a struggling consumer that's losing their jobs. All these things start to trickle higher. Now, initial jobless claims, non-farm payroll, all these things have been historically pretty accurate, or I should say pretty satisfactory. And so, the argument of like what happened in July and August with the SOM rule being activated, that's supposed to be the undefeated recession indicator. Look, all the recession indicators for the last 2 years have not worked. Period. They're all wrong. Okay. The inverted yield curve, you know what I haven't looked at in a while? How about the 3-month and the 10-year? Okay, I haven't looked at this in a moment. Let's go to the 3 and the 10. We are still negative. This is a whole nother can of worms that it's like, yeah, if we get out of this, you go back to the chart. This is the longest and deepest 10-year and 3-month inverted yield curve that we have ever had. All these vertical lines have triggered recessions. And what are they? It's not the inversion, it's the disinversion. And we are so freaking close to getting disinverted. So just saying, is that a really simple, like martingale, right? Is that the canary in the coal mine? If we get out, all of a sudden, this is at the 0 line or going positive like the 10 and the 2-year did, is that going to trigger anything? Maybe, So it could be something super easy to spot. It could be something super difficult, but I'll leave you with this today. Okay. This is the reason I am waiting for better opportunities. Okay. You can take a look at any of your favorite stocks on a daily time frame or even a weekly time frame. Look at this. This weekly hasn't hit anything outside of a 21 moving average since fall of last year. Okay. The daily chart is another one. We have had nothing but bounces off of the 21, the 50, the 100. We actually hit the 144 on that Valmagen event in August. But other than that, this thing has been only moving up with a test of like the 21 and the 50, those very shallow moving averages. And so when we stretch away, and I keep talking about this is the bar count. It's this simple. I don't care what stock you look at. Okay, you can look at freaking MicroStrategy, Coinbase. You can look at all your, Bitcoin ETFs. You can look at Bitcoin. You can look at the Nasdaq. You can look at your Mag 7s. I don't care what stock you look at. If it looks something like this, where the stock is sitting here at all-time highs, and you have all this space between current price and every one of your moving averages, I'm just saying we're probably going to have a pullback. Now, this might have some fuel in the tank to go a little bit higher, and that's fine, right? And this is why we've said this for months now. Don't fight it until price confirms it. If price finally takes out a low, okay, and takes out a previous high, and it's like it's not bouncing anymore, and it comes back and closes below moving average, it's typically going to close below this moving average and gravitate to this one. If it bounces there, great. If it closes below this one, it's probably moving to that one. Okay. But we will spot some type of topping pattern. And usually the markets, if it's going to be like a healthier cycle, we might see the market go up, go sideways, and then start to roll over. That's better than when it goes up and it like freaking, gets hammered down and then dead cat bounce and then hammered down again. But once that's over, look at your percentage and is it worthy of buying? Is it a big enough discount to buy? If yes, I'm buying. If not, I'll wait. But this is why I have cash at the ready. Okay. So it's exhausting, right? It's exhausting to think about like what can happen. But I look, all this like potential cynicism, it goes away when the market has a reality check for me. I've been in these markets for a long time. I know what complacency looks like. I know what euphoria looks like. I know what greed looks like. It kind of looks like this, right? When we've got double leverage instruments that everyone's talking about, when I've got people that have never talked about Bitcoin talking about Bitcoin, when I've got people that have told me about their portfolio being up 30, 40, 50%, they're just going to keep investing the way they've been investing the last 2 years thinking this is what the market is. it's not the market. Okay. We are in a unique window of 2 years where this market has been extremely bullish, and that's great. It's easy to make money in a very healthy, aggressive bull market. The real trading and investing comes from surviving a trim and surviving a crash and having the cash to deploy and generate the wealth when the market does something like this. When the market does something like this and you have the cash to deploy and then we get back to those all-time highs, that's where we make a lot more money than just the constant higher highs. You know? But if you don't have the cash and you're fully invested up here, you're just on the hook for that full correlation. And if the Nasdaq is aggressive and it's like, man, the Nasdaq went down 20%, the S&P went down 12 to 15%, you're going to feel that. And all those traders out there with double leverage MicroStrategy and double leverage S&P and double leverage Qs, they're going to feel that. So that's where the cleansing comes in, you know? So all I'm saying is I'm just going to be ready for it. And if it costs me 0.25% of my account every month, fine. The melt up I get paid, the hedge, I'm going to wait for. Eventually, if I'm right, maybe my 0.25 that gives me maybe 2 to 3%. Look, I can hedge and lose. And if I get a 2 to 3% hedge, it pays for itself. I improve my position and I can buy things at a lower price with the cash that I have available. So anyway, this would be like the last time I sound like a broken record. All right. I think it's been on my mind a lot. When I'm able to sit here and have these live sessions, this is what I'm talking about. I'm talking about everything I'm doing in my portfolio. So I don't know if everything we've talked about is going to be the reason certain things happen, but I'm saying that I don't think 2025 is going to look like 2024. I don't think 2024 looked like 2023. 2023 didn't look like 2022. There's never a year that feels like it's so easy, right? This has been a pretty easy year. It still had some bumps and hiccups along the way. If you stayed the course, it was fine. The market clearly was excited about everything going into the end of this year, the Fed cutting, the timing with Trump coming back into office. Look, if Trump didn't get elected president, the guy's probably going to jail. Like, I'm curious what happens in 2028 when he's a civilian again. I don't know. But we won't have to worry about that. And here we are. Like, clearly the country wasn't ready for a woman president. The Democrats probably shot their foot with everything that happened in the election. I don't care. This isn't about a political thing. It's just 2025 to 2028 will be an interesting window. This could be party like it's 1998, 1999, and the market still has room to run because we're sitting here with a strong, resilient economy with the Fed being accommodative. But it's hard to think that valuation this high, inflation starting to go higher and trending higher, the Fed is likely not going to be as dovish and cut. And I keep watching that 10-year. I'm watching that 10-year so closely because it matters. Okay. This thing is up again for the last 3 or 4 days, right? You want to buy a house? If this is going higher, you're probably paying higher interest rates. This goes lower, you get a little bit better discount. But we are a long ways away from where we were when the Fed cut in September. Rates were down to 6% mortgages. They were 6.09. Now they're up to 6.7. That's a big difference. Over the course of a 30-year mortgage, that is a crazy difference in house price. Okay, so if this goes higher and we creep up to mortgages at 7%, there's another thing. Employment goes higher, recession based on a housing market correction. Maybe not a crash. This isn't 2008 all over again, but a correction. House prices come down. Household equity goes down. Everyone's been sitting here thinking their house, I bought this house for $300,000. It's appraised at $1 million. I'm sitting on $700K. We are flush, baby. Well, all of a sudden that $1 million appraisal goes down to $800K, goes down to $750K. You want to put your house in the market, it sits in the market for 6 to 12 months. That's not a good thing. We're sitting here with crazy high housing prices, crazy high interest rates. Nobody can sell because the prices won't sell at these current rates, and nobody's buying at 6.5% to 7.5% interest rates. That's where we're at. So the housing market is at a standstill. There's supply that's coming online, but people can't buy a freaking house. And again, I've got a unique market out here where everyone has money, and we've got home builders that are starting out builder grade manufactured homes that are sitting around like $700K just to get started, $1 million with the trimmings in the lot. $1 million home that is probably a $400,000 house, but it's $1 million. So anyway, I'll cap the cynicism right there. Be prepared for a trim. That's all I'm saying. A trim could be a good opportunity because if let's just say from highs, here's what kind of end today. Okay. If we are sitting here at highs, Okay. And we sneak in another couple of all-time highs, that's great. But as soon as we have some type of correction, the amount of effort it takes to get back to that high, we might not have the thrust and momentum to go higher, right? So if all we have is we have some highs, we have a correction, and then the market just kind of plays around with this. And one really good sign for the market is a broadening pattern, because traders get fooled by thinking it's going to crash or it's going to rip, and they get beat up both ways. So 2025 might be the first year in a while that we actually have the price not going higher, not going lower, but it's going to be this. Maybe the market finds a way to end on a high note and be at 10% for the year, but it's after all this volatility. Look at 2015, look at 2016. The market was sideways with 20+% pullbacks. That was not a fun 2-year window. But if you stayed the course and you had a horizon, it's like, oh, just long-term investing. Well, we're not long-term. I mean, yes, we're long-term investors because I'm going to do this for a long time, but I'm trying to find ways to make money this week and this month and this quarter and this year. So I don't care what the market gives me. I'm trying to make money. So I will do my best to continue to assess whatever this is. I'd say lower expectations for the market in 2025. If we get to a 10 to 15% run to higher highs, that'd be pretty impressive. And so I'm hoping to get there. We maybe have a bit of a reality check first that we can buy into, as opposed to melting up and seeing that the market's up, 15% for the year, and then it gives it all back. And then we spend the rest of the year just fighting and floating and treading water until it finally maybe gets back to the high by the end of the year. So, all right, enough of my forecasting. Am I just spewing cynicism? I don't think so. And look, I'm saying this while I'm up at like fresh watermark highs. I've had a good year. I don't know why I'm complaining, but I think I'm just ready. I'm just ready for something. Like, we need to have something change. We need to have a little bit of an opportunity to have a buying opportunity, because I can't buy at 26 valuations, right? Price to earnings at 26 is historically high. I can't buy there. This type of stretch we move and this type of bar count, I can't buy here. I'm just participating, like little scalps, little income trades, but I am taking all of my trades with this. There's resiliency in my strategies. So if my hedge gets paid, great. Right? If my hedge pays out, great. If the market melts up higher, great. I can make money to the upside, I can make money to the downside. I can make money if the market goes sideways, but I'm just trying to be well equipped for whatever the market throws at us. Okay. All right. Next year, quantum bubble AI is old news. Possible. But you got to wonder with that quantum stuff, is that going to change the landscape? I mean, I'm reading stuff like this quantum computing is going to be able to, hack the blockchain. Bitcoin's not safe within 4 to 5 years, blah, blah, blah. It's like, I don't know. But it's like everything that is like trying to get your opinion and get your attention is doom and gloom, So I'm trying to be somewhat like balancing out. I'm not doom and gloom. I'm just being pragmatic, Like I said, if you think back, if anybody watching this has been trading since, 2018, 2019, 2020, we've seen booms and busts. And unfortunately, it doesn't feel like we're going to stop doing that. I mean, this to me feels like we've had a boom for the last 2.5 years, because we got through that October. So just under 2.5 years, this has been a pretty big boom. Is it a bubble? I mean, it doesn't have to burst and be a bear market, but man, like a little bit of a reality check and seeing, valuations at 26 price to earnings go back to 20, go back to 21. Just give us something where it's like things aren't overvalued, things aren't fundamentally strong, or things aren't fundamentally too expensive. So that's it. And like I said, when I see traders that are always talking about, 2x leverage this and it's killing it, I'm doing this, I'm making so much money, it's like, that's awesome. But that's also the trader that rarely protects themselves to the downside. When traders are all in on Bitcoin, they're all in on double leverage instruments, they have no protection to the downside, they're fully invested, they've beat the benchmarks, and they're just out there just like, it's so easy, it's so easy. I get a little contrarian. That's all I'm saying. Okay. So if we have, stalling or plateauing money supply, okay, if we have global liquidity that starts to plateau or shrivel a little bit, if the Fed makes a big pivot where They all of a sudden just start, I don't know, and they probably won't be like flipping policy and raising rates because that would be an absolute catastrophe if they did. They might, that could be like an easy outlier, like, yep, the Fed just completely messed up and they pivoted hard and all of a sudden they're raising rates and it's like the market's going to absolutely hate that. So that in and of itself could be something, but the 10-year and the 3-month is something to watch. The 10-year yield is something to watch. Unemployment rates, inflation data is something to watch. You know, valuations and price action is something to watch. Nothing about today's price is suggesting we're crashing. Nothing about today's price action is suggesting that we're going down. So, am I early to this? Sure. But month to month, I'll be in it because what you can't do is when the market goes like that, you can't hedge that. You got to be in it before it happens. So that's why I'm willing to take that 0.25% risk because if that happens, that pays me 2 to 3% typically. You know, is it going to offset all my drawdown? No, but it's going to help me alleviate it. Because if I can get this thing down, let's say 5 to 10%, I make up 2 to 3% on a hedge and I can start repositioning with capital. I mean, I can get that recovery plus the 2 to 3%. I can end up getting to higher highs before we ever get back to the higher highs. So my portfolio can be in a better position well before we actually get back to those higher highs. But I got to pay for that every month or every, 45 to 60 days. Usually I do like 30 days because it's not crazy expensive. All right. So if the market goes up, you lose your hedge money. No, not at all. That'd be like the dumbest hedge ever, right? I hedge with a fraction risk, 0.25% risk. If I go up, I usually get about a 2% upside if we go up like half to 1%. And if we go down, I turn that 2.5% into a 2 to 3% gain. So, I mean, if we melt up higher, I'll be fine. If I pay a 0.25% and I'll just be real. Let's say that I lose every month for the next 12 months. I go 0.25 times 12. Okay. What's the worst case scenario for me if I were to hedge every month and lose 0.25 times 12? I'm sacrificing 3% of my account that's up nearly 40% this year. Am I okay with the 37% net gain on the year? Yeah. I'll pay for the hedges. So I'm not net even on a hedge. That's the dumbest hedge ever. I pay for very cheap hedges that when they pay out have 5 and 10x returns. That's my style. Does it work all the time? Hardly ever. But in the 1 or 2 times that I need it, like I did back in July and August, I had like a 800% return on the VIX and a 500% return on my futures trades. So that paid for itself. And then it was easier to get to those better positions when we had a rip in September. That got me back. I was at all-time highs in my portfolio before we even got to the all-time highs in the markets. So that's how it works. Okay. Do I place a stop loss? No. That's why I trade options, because it's risk defined. I don't need a stop loss. I can risk the dollar and the percent amount that I want, and I just place the trade and I can go to infinity or zero and I'm going to lose the same amount. That's the beautiful thing about options. Risk defined. Okay. Lucas asking about Bitcoin. What do you think they'll do after Christmas rally? I don't know. I mean, I think Bitcoin, if we have a reality check on Bitcoin, we pull back to, I mean, I have this measure move around 107 to 108. The one thing I'm watching on Bitcoin as well is I still like this kind of inefficiency level around this like 90K to 80K. I think this is where the market can kind of check and reestablish some longs. But if we keep going higher and we hit symmetry, I would look for a little correction there. If we end up breaking that structure, we probably have a little bit of a pullback, come back into some like efficiency levels, and then maybe establish some longs. Okay. I mean, I think the trend is decent, but we all know, if anybody's been watching Bitcoin for the last, 8 years, 9 years, 10 years, I mean, I think 50% to 70% is something we have to mentally be prepared for. That's the potential pullback, you know? So could we go from 100 grand back to 30 grand? I mean, that would suck, but we could. Could we go from 100 grand back down to 74? 100% we could. So if this is our previous all-time high, can we find our way back to it? Sure, we could find that again. And then we'll see if the market builds and then goes up to higher highs. But if this goes higher and higher and higher, what I'm going to look at technically would be, if we get a nice high and a pullback, we probably have a run back up to these highs. That's probably where I'm looking to protect and start reallocating and changing up percentages. And I say that because this high and this high with divergence probably means a topping pattern, probably means a correction, and then we reestablish a bull market. So, I mean, 107, 108,000 is my technical target here. That's my technical target where I'm not going to dump my profits. I've got good positions running, but if it melts up higher through that, okay, and then a higher high with divergence, that's where I'm probably going to start taking some profit. Okay. Now, how much of that? Enough, because right now my 3% Bitcoin allocation, it's been anywhere between 3 and 5%. Right now I'm showing, I mean, I can look at my portfolio here, but between my Bitcoin positions, let me go to a little bit of everything here. So I know BITO right now is up like 25, almost $26,000. Coinbase is up $5,500. IBIT is up 40, almost $45,000. MARA is up $5,200. MicroStrategy is up $8,500. I mean, I want to protect those profits. You know, Coin, I think I did Coin already, didn't I? Coin's up, yeah, $5,400. So, I mean, my exposure has some good profit. And I want to capitalize on all that profit, and I'll, you know, so my allocation is up. I don't even know what those numbers were, but I'll obviously do the portfolio review. But it's probably stretched my portfolio to now showing that I've got about a 6 or 7% allocation to Bitcoin. I want to go back to like 3 to 5%. You know, historically, I mean, this is why Bitcoin, I think, is a no-brainer for most traders. A 1% allocation over a 10-year window has produced a 16% average in your portfolio. Okay, if you had a 1% allocation to Bitcoin and you had a 99% allocation to the SPY, okay, you've averaged about 16% a year. Now that might not sound like a lot, okay, but that, with that allocation right there, you've essentially doubled the annualized performance of the S&P, which averages around 8 to 9%. So a 1% allocation. So I thought, well, I can justify 3%. Because if I put 3% in, all of a sudden this becomes a 25% average or a 30% average. That's pretty good. But is that how I'm invested? Is 1% Bitcoin and 99 SPY? No, of course not. I'm way more diversified than that. But I'm able to justify having a 3 to 5% allocation because I may introduce a little bit more volatility. But now that I can trade Bitcoin and trade options, I can control that risk and also control that downside and protect myself too. Okay. So a lot of ways to think about it. You know, you're just playing chess. That's all. Do I mostly trade options? Yep. I mean, I moved an $8 million currency fund, took a large portion of that, and now I'm trading stocks and options and futures simply because I can trade options most of the time and control my risk. You know, I mean, I'm up nearly 40% this year with a less than I think my biggest drawdown was about 7% this year. That risk adjusted return is pretty good. It's like one of the best I've ever had. So, I mean, to me, it was the right decision to start navigating my portfolio into this arena because I just think about all the forgiveness that I have if I'm wrong, right? If this it doesn't matter what it is. This could be any stock, whatever. If this thing goes up to infinity or down to zero, my trade is right here with defined risk. So if I risk, let's say 0.25% of my account and I'm wrong, that's all I lose. And I could be dead wrong in price. But if I win, I can usually get maybe a 0.5% winner. Maybe I've got a higher asymmetry upside where I can get like a 1% winner. But if I'm wrong, I'm only risking that, you know? So imagine building a portfolio with having upside of, you know, 2 to 3 times what you're risking, but your downside is always risk defined. I can survive forever and be dead wrong. Options is the only asset I know to do that. So that's why I trade it. It's a game changer when it comes to managing your portfolio and having better risk management. Okay. All right. So look, I've been all over the place, right? I mean, I started trading stocks when I was 18 years old in the year 2000 and was, you know, passively investing for 20, not what I do now. I mean, I learned to trade from professionals. I've been on the institutional floors in banks. I've seen what banks do. I see what market makers do. I see what retail traders get used for. They get used for liquidity. But I'm a retail trader. I mean, I don't have institutional stuff. I've seen the tools and resources. It's like, but it's really no different. I just don't have the capital to build. You know, I did this conference in Australia, and there was a high frequency trader that's been in the institutional side for 20 years. He has tools or had access to tools that I can't use. So the best thing I can do as a retail trader is be better at risk management. Unfortunately, that's what most retail traders suck at, is they manage risk like idiots. You know, they're all in, they're over leveraged, and they're overexposed, and then they get smoked when the market's not going exactly where they need it to go. You know, and when you're trading things like futures, you trading things like Forex, if you're not super precise and super disciplined, it's so much leverage and you have to be right. Look, with options trading, I can be so wrong and lose no more than what I initially started the trade for. I don't know what other asset you can do that with. I can whiff the direction and be wrong. Like, look, Nvidia can go down to 0 and I would lose, 0.25% of my account. Okay. Like, what Forex pair can you do that with? What futures contract can you do that with? None. So options trading will help everybody if you want to learn how to trade it. It's the greatest asset to trade, in my opinion. It is what brought me to I would consider myself a professional trader. And even that's putting it loosely, just because, look, I work for a hedge fund. You can do whatever you want and you can make the biggest mistakes and you can blow up your account. If you got deep enough pockets of the hedge fund, nobody notices, right? That's not me. I mean, I would say I'm fairly conservative. You know, I've got capital that I care about. I've got client capital that I care about. I trade it like it's my own. All I'm trying to do is not lose money. The profits come mainly because I don't lose money. Markets aren't that hard if you don't lose money. Okay. All right. So anyway, if anybody's interested in learning options, I've got plenty of stuff. If you're involved with the Pulver alerts, if you're involved in any of my services, I mean, I teach options like crazy. The easiest way to get started, I've got basically 2 crash courses called Practical Options. One of them's $27. The other one's a full service at $497. I give you the $497 bonus if you get the Pulver alerts with the VIP membership. If anybody's in my services like Daily Profit Play or Waterfall Income or Double Up alerts or anything with Prosperity Pub, I give that away. So, like, I'm here to help. I am a trader just like all of you. I'm a retail trader just like all of you. I just been doing it for a while, and so that's why today it's like it sounds a little bit more public service announcement, right? Like that's kind of the mood I was in. But it's just it's strange to watch the market do what it does. And look, I know that the reality of this seasonality is like right now, why would the market go down? You know, I mean, you know how pissed investors would be if the Fed fudges up this rally by the end of the year. So it's probably not going to change. You know, expect to see the market go to another all-time high or 2 or 3 by the end of the year, just because it can, just because there's nothing to prove that it's going the opposite way. But when it rolls over, just saying, be prepared for that trim. And the news and all the things that the reasons why it all just lines up after the fact. But right now, it looks a little overextended. It looks a little long in the tooth. It looks a little divergent to me. It looks a little complacent, looks a little everything. It just looks high. And I know it can keep going. But once we blew the top off in the election and we had a nice pullback and then another rip higher, and we're just getting these tiny little all-time highs, this feels a lot like the top was in July. These tiny little like 0.1% higher all-time high. It's like the news just says all-time high, when it's like it's 0.1% higher. Like there's not a lot of momentum behind these all-time highs. So it's just melting up. So I just think this drifts until it's ready, and then we start to see reality. Okay. But reality doesn't mean crash. It just means let's get a correction. Let's get something we can work with. Let's get something we can buy a dip on, and we'll see what 25 has in store. I'm as excited to trade in 2025 as everyone else. I just don't think it's going to be as easy as it's been the last 2 years. So be prepared to navigate some tricky waters. Okay. Gold. Yep. I'll take. Oh my. I've been running for a while here. Do I have? Hang on a second. Let me make sure I'm not missing anything. Okay. I'm good. I'm good. Yeah. Okay. Let's take a look at gold. Just want to make sure I didn't have anything on my calendar. Okay. Well, if you've been with us in these live sessions for the last month, somebody tell me what I've said on gold for the last month. Am I buying gold right now? I bought gold right here. That's a 100 moving average. I'm going to buy more gold right here. That's a 200 moving average. There's trend line support. There's good structure back here. There's a high, low, lower, high, lower, low. That's what I'm waiting for. Okay. If the dollar's going to get stronger, that's probably going to put pressure on gold. So if gold goes down here, we're back to the range. We're back to that same candle. So I talked about this. This could be just chop city. We're not making highs or not making lows. It's just going to be, a little liquidity grab all over the place. But because we had such a good bull market, this is a fifth wave completion. I'm at least looking for an ABC correction. If that's all we get, I'll get long on gold and I'll hold it long term. But I'm not forcing trades. Okay. So whatever happens, I mean, if it gets all-time highs, awesome. If it pulls back, I'm buying more here. If it gets all-time highs, I'm just riding the wave in the melt up. Silver, same thing. Okay. Silver's pulling back in a big way. Fine. Does this do any structural damage to silver? Not really. It's still well supported around 29.50. It's still really well supported at 26. I just don't want to see it get down to 26 because then all of a sudden we change the trend. Higher highs, higher highs, higher lows, higher lows. If we get back down to 26, there's a lot of support there becoming, or this is resistance becoming support, but that would change the structure of this trend. So I'm hoping that all we're doing is kind of building and basing here, and then we are justifying another rip on silver towards 2025's upside. So I still like silver a lot more technically than gold, but they both have their place in a portfolio. And then Bitcoin, same thing. I've got a measured symmetry move right around that 107,000. It's like 107 to 108,000. So if there's a reaction to that, that's just a measured move. That just shows how technically pure Bitcoin can be, just like with Forex currencies. This is why I don't like the Japanese yen. But if we hit symmetry and it retraces, okay, so all we do is kind of break the structure, maybe have a bit of an ABC, pull back into this area. I'd like to buy more and then see if we go up. That could be a healthy bull market. We'll keep an eye on it. But I want to buy more Bitcoin at a better price. So I was aggressive. Look, I was aggressive for months on Bitcoin. Lows, 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 averaging in on Bitcoin. Breakout, added some more. That run to 100K, that was the story that everyone was talking about with the potential of Bitcoin running to 100K. Did it get there? Yes, it did. So, my trades paid off nicely this year in Bitcoin. All the while this was happening, I was saying for months, I'm like, look, I've got this allocation to Bitcoin that hasn't performed yet at all. And so if there's anything on Bitcoin and anything on China, there's some big boost in my portfolio. And I've gotten most of those. China's been a bit of a tricky one because we've had these big jumps to the upside and then they just fade so fast. So I've limited some of that concentration in China. I only have like 3 stocks now, and I own 2 of them, and I'm trading options on all of them. So it's defined risk. I have some ownership. I'm working my cost basis down when I can, but I'll repair those, and I'm just looking for income plays at this point. I was going to be more bullish if it was follow through, but we're not getting the follow through on China, so I'm not going to be crazy bullish. Okay. What do you use? So yeah, it's right here. It's the 21, 50, 100, 144, and 200. Very simple. They're all EMAs. EMA. Okay. And usually I'm referencing these on a daily time frame, especially when it comes to stocks. On currencies, I'm looking at a 1 and a 4-hour chart. And then if I'll take it, like if I like the direction of a 1-hour, 4-hour chart, then I'll transfer that down to like a 30-minute or a 15-minute. Okay. And I can, if I have to get in the trenches, I can trade a 1 and a 5-minute in currencies, but I rarely do that. I will do that in futures as well. 1 hour in futures, 1 and 5-minute in futures, but daily charts. I mean, it's the nice thing is that it translates nicely on every time frame. It's just these are kind of my go-tos. So really simple moving averages. Well, exponential moving averages. Simple meaning it's easy to review them. But don't get confused. There's smooth moving averages, there's simple moving averages, there's weighted moving averages, there's linear moving averages, there's triangular weighted, blah, blah, blah. Exponential moving averages is my favorite. Okay, EuroCAD Mason, no trade, man. I don't like it. Dollar CAD's the only CAD I'm in right now. CAD Swiss long, dollar CAD long. That's it. All right, everybody. I'm going to let you go. A1 trading team, thanks for letting me stick around and rant for another, typically 15, 30 minutes and longer than usual. But I don't know. We had a good message to get out today. Okay, thanks. We'll see you tomorrow. All right, bye.